It was 2016, and Warren Buffett, the legendary Oracle of Omaha, stood at the precipice of what would become one of the most controversial investment decisions of his storied career. The air was thick with anticipation as news of a potential mega merger between Kraft and Heinz began to circulate through the financial world. On paper, it seemed like a match made in heaven, two iconic American brands joining forces to create a food industry behemoth. As Buffett pored over the numbers, his eyes gleamed with the promise of synergy and market dominance. The potential was staggering: billions in cost savings, unparalleled brand recognition, and a stranglehold on supermarket shelves across the globe. Wall Street analysts were practically salivating at the prospect, their reports filled with glowing projections and buy recommendations. But beneath the surface of this seemingly perfect deal, a quiet unease began to stir. In the hushed corridors of Berkshire Hathaway's Omaha headquarters, some of Buffett's most trusted advisors exchanged worried glances. They had seen the shifting sands of consumer behavior, the growing trend towards healthier, less processed foods. Millennials, in particular, were turning away from the very products that had made Kraft and Heinz household names for generations. One advisor, her voice barely above a whisper, dared to voice what others were thinking. "Warren, are we sure about this? The market is changing faster than we've ever seen. What if we're betting on the past instead of the future?" Buffett, known for his unwavering trust in his own instincts and long-term vision, listened politely but remained unmoved. He had built his empire on seeing value where others saw only risk, on zigging when the rest of the market zagged. This deal, he believed, was no different. As the negotiations entered their final stages, the excitement in the financial world reached a fever pitch. CNBC anchors breathlessly reported on every rumor and speculation. The merger was hailed as a masterstroke, a testament to Buffett's legendary acumen. Berkshire Hathaway was set to invest billions, cementing its position as a cornerstone investor in what would become one of the largest food companies on the planet. Yet even as the champagne corks popped and congratulatory messages flooded in, a nagging doubt lingered in the back of Buffett's mind. He found himself in a rare moment of vulnerability, confiding in a longtime friend over a quiet dinner. "You know," Buffett said, his voice uncharacteristically hesitant, "I can't shake this feeling. The numbers add up, the strategy makes sense, but I hope this isn't a mistake." His friend, taken aback by the admission, tried to reassure him. "Warren, you've made bolder bets before and come out on top. Why the doubt now?" Buffett's response was telling, because this time, it's not just about the money. It's about legacy. It's about whether we're reading the future correctly or clinging to the past. As the final papers were signed and the merger became official, the business world celebrated what they saw as yet another triumph for the Oracle of Omaha. Kraft Heinz was born, a colossus straddling the food industry landscape, promising to reshape the way America and the world ate. But even as the ink dried on the contracts, trouble was already brewing beneath the surface. The newly formed company faced challenges that would test even Buffett's legendary patience and wisdom. Consumer tastes were shifting faster than anyone had anticipated, and the very foundation of the processed food industry was beginning to crack. In boardrooms and strategy sessions, executives grappled with a sobering reality. The world was changing, and Kraft Heinz risked being left behind. The synergies that had looked so promising on paper proved elusive in practice. Cost-cutting measures, once hailed as a path to profitability, began to take their toll on product quality and innovation. Meanwhile, smaller, nimbler competitors were eating into market share, offering healthier, more authentic alternatives that resonated with younger consumers. The very brands that had once dominated pantries across America were now seen as relics of a bygone era, out of touch with modern dietary preferences and values. As the months turned into years, the cracks in the Kraft Heinz facade began to widen. Sales stagnated, then declined. The stock price, once a source of pride for Buffett and his team, began a slow but steady descent. Analysts who had once sung the merger's praises now sharpened their knives, questioning the wisdom of betting so heavily on processed foods in an era of kale smoothies and artisanal everything. Buffett, ever the pragmatist, watched these developments with growing concern. He had weathered market storms before, had seen investments rise and fall over the decades. But this was different. This wasn't just about money, it was about his judgment, his ability to read the economic tea leaves that had served him so well for so long. In quiet moments, away from the prying eyes of the media and the expectations of shareholders, Buffett found himself revisiting that conversation from years ago. "I hope this isn't a mistake," he had said. Now, As the evidence mounted and the criticisms grew louder, those words haunted him. The turning point came in 2019, when Kraft Heinz announced a staggering $15 billion write-down, sending shockwaves through the investment world. The stock price plummeted, wiping out billions in market value overnight. For Buffett and Berkshire Hathaway, it was more than just a financial loss. It was a public admission that the Oracle of Omaha had, for once, misread the future. In the aftermath of the announcement, Buffett faced the harshest scrutiny of his career. Investors demanded answers. The media circled like sharks smelling blood in the water, and even his own board questioned the wisdom of the investment. It was a moment of reckoning, a test of character that would define the twilight of Buffett's storied career. As the dust settled and the full extent of the Kraft Heinz debacle became clear, Buffett did something that few in his position would have dared. He admitted he was wrong. In interviews and shareholder meetings, he spoke candidly about the mistakes that had been made, the assumptions that had proven false, and the lessons learned from this costly misstep. "We overpaid," Buffett acknowledged, his voice heavy with the weight of the admission. "I made a mistake in valuing Kraft Heinz, and it's one that I'll carry with me." This public mea culpa was more than just damage control. It was a testament to the integrity and humility that had made Buffett not just a successful investor, but a respected leader. In owning his mistake, he demonstrated a rare quality in the cutthroat world of high finance: the ability to learn and grow even in the face of failure. As the Kraft Heinz story continued to unfold, with efforts to right the ship and adapt to changing consumer tastes, Buffett's experience served as a powerful reminder of the risks and challenges inherent in even the most seemingly sound investments. It was a cautionary tale for investors everywhere, a stark illustration of how even the most brilliant minds can be blindsided by shifting market dynamics. Yet in the end, it was also a story of resilience, of the importance of facing one's mistakes head-on and using them as opportunities for growth and learning. As Buffett himself often said, the most important thing to do if you find yourself in a hole is to stop digging. The Kraft Heinz saga may have been a low point in Buffett's career, but it also offered a glimpse into the character of a man who had built an empire, not just on financial acumen, but on integrity, honesty, and a willingness to adapt. As the story of this ill-fated investment continued to unfold, one question lingered in the minds of investors and observers alike. If you were Warren Buffett, would you trust your instincts or listen to your advisors? The answer, as Buffett himself had learned, was perhaps more complex than anyone could have imagined. In the ever-changing landscape of global finance, sometimes the wisest choice is to do both, to trust your gut, but also to remain open to the voices of caution and dissent. It's a delicate balance, one that even the Oracle of Omaha was still learning to master. It was 2016, and Warren Buffett, the legendary Oracle of Omaha, stood at the precipice of what would become one of the most controversial investment decisions of his storied career. The air was thick with anticipation as news of a potential mega merger between Kraft and Heinz began to circulate through the financial world. On paper, it seemed like a match made in heaven, two iconic American brands joining forces to create a food industry behemoth. As Buffett pored over the numbers, his eyes gleamed with the promise of synergy and market dominance. The potential was staggering: billions in cost savings, unparalleled distribution networks, and a portfolio of household names that would grace pantries across the globe. Wall Street analysts were practically salivating at the prospect, their reports filled with glowing projections and buy recommendations. But beneath the surface of this seemingly perfect deal, a quiet unease began to stir. In the hushed corridors of Berkshire Hathaway, some of Buffett's most trusted advisors exchanged worried glances. They saw storm clouds on the horizon, shifts in consumer behavior that threatened to upend the very foundation of the processed food industry. "Warren," one advisor cautioned during a late-night strategy session, "the market is changing faster than we anticipated. Millennials are turning away from packaged foods. They're demanding healthier, fresher options. Are we sure this is the right move?" Buffett, known for his unwavering trust in his instincts and long-term vision, listened intently. He'd built his empire on identifying value where others saw only risk, but even he couldn't ignore the nagging doubt that crept into his mind. As the days ticked by and the merger negotiations intensified, the excitement in the financial world reached a fever pitch. CNBC anchors breathlessly reported on every development, their voices filled with awe at the sheer scale of the deal. Berkshire Hathaway was set to invest billions, a testament to Buffett's confidence in the merger's potential. Yet, behind closed doors, the debate raged on. Buffett's inner circle continued to voice their concerns, presenting data on changing dietary habits and the rise of organic food startups. They painted a picture of a future where Kraft Heinz's core products might become relics of a bygone era. Buffett listened, his brow furrowed in concentration. He weighed each argument carefully, his mind racing through decades of investment wisdom. The rational part of him acknowledged the risks, but there was something else, an emotional pull towards these iconic American brands that had been a part of his life for as long as he could remember. As the final details of the deal were hammered out, Buffett found himself at a crossroads. The numbers looked good, the potential for growth was there, but that tiny seed of doubt refused to be silenced. In a moment of rare vulnerability, he confided in a longtime friend and fellow investor. "I can't shake this feeling," Buffett admitted, his voice barely above a whisper. "The deal makes sense on paper, but something doesn't feel quite right. I hope this isn't a mistake." His friend, sensing the weight of the moment, placed a reassuring hand on Buffett's shoulder. "You've been right more times than anyone can count, Warren. If anyone can make this work, it's you." With a deep breath and a nod of resolution, Buffett made his decision. The merger would go forward, with Berkshire Hathaway's billions backing the newly formed Kraft Heinz company. As the ink dried on the contracts and champagne corks popped in boardrooms across the country, Buffett allowed himself a small smile. He'd taken the leap, trusting in his decades of experience and the enduring power of American consumer brands. But as the initial euphoria of the deal began to fade, a subtle undercurrent of unease remained. Kraft Heinz was poised to begin its new chapter as a global food powerhouse. But beneath the surface, trouble was already beginning to brew. The merger announcement sent shockwaves through the business world. Headlines trumpeted the creation of the fifth largest food and beverage company on the planet. Investors scrambled to get a piece of the action, driving stock prices to new heights. It seemed that Warren Buffett had done it again, spotting an opportunity that would reshape an entire industry. In the days that followed, Buffett found himself inundated with congratulatory calls and messages. Fellow billionaires, politicians, and even celebrities wanted to share in the excitement of what many were calling the deal of the decade. The Oracle of Omaha graciously accepted their praise, all the while wrestling with the lingering doubts that refused to be silenced. As he sat in his modest Omaha office, surrounded by stacks of financial reports and market analyses, Buffett couldn't help but reflect on the enormity of the decision he'd just made. Billions of dollars were now tied up in a bet on the future of processed foods, a future that seemed increasingly uncertain with each passing day. At first, the merger seemed like a success. Kraft Heinz reported strong cost-cutting gains and profits looked solid. The newly formed food giant was flexing its muscles, slashing expenses left and right. Wall Street analysts were impressed, praising the company's lean and mean approach. Shareholders were happy, watching their dividends grow. It was a textbook example of how to create value through consolidation. But beneath the surface, trouble was brewing. As Kraft Heinz focused on trimming the fat, they failed to notice the shifting ground beneath their feet. Consumer tastes were changing rapidly, and the processed food empire that had once dominated supermarket shelves was starting to look outdated. Health-conscious millennials were flocking to organic produce sections. Plant-based alternatives were exploding in popularity. Fresh, locally sourced ingredients were all the rage, and there sat Kraft Heinz, still churning out the same packaged cheese slices and sugary ketchup that had been their bread and butter for decades. Sales began to stagnate. Market share started slipping away. The cost-cutting measures that had initially boosted profits were now squeezing the life out of beloved brands. Innovation suffered as R&D budgets were slashed. New product launches fell flat. The company that had once set food trends was now struggling to keep up. Inside the hallowed halls of Berkshire Hathaway, worries started to grow. Warren Buffett, the Oracle of Omaha himself, had championed this merger. He had staked billions on its success. Now, as the cracks began to show, his lieutenants were getting nervous. At a tense quarterly meeting, one executive didn't mince words. Looking Buffett straight in the eye, he declared, "We're squeezing a rock, and it's already dry." The room fell silent. It was a stark assessment of Kraft Heinz's predicament, and a challenge to Buffett's judgment. Industry analysts weren't pulling any punches either. They warned that the aggressive cost-cutting strategy might be damaging the long-term value of the brands. Short-term profits were being prioritized over sustainable growth. It was a recipe for disaster in a rapidly evolving consumer landscape. But Buffett, ever the contrarian, doubled down. He increased Berkshire's stake in Kraft Heinz, sending a clear message to the market. He still believed in this investment. Publicly, he defended the company's strategy, praising its management and expressing confidence in its future. Yet behind closed doors, doubt had begun to creep in. For the first time in years, Buffett found himself questioning his own judgment. Had he misread the market? Had he underestimated the pace of change in consumer preferences? The man known for his unerring instincts was facing a rare moment of uncertainty. Late one night, alone in his office, Buffett pored over financial reports and market analyses. The numbers didn't lie. Kraft Heinz was losing ground, and fast. He rubbed his temples, feeling the weight of billions of dollars and thousands of jobs resting on his shoulders. This wasn't just about money anymore. It was about legacy. As dawn broke over Omaha, Buffett made a decision. He would stand by Kraft Heinz for now, but he also knew that tough choices lay ahead. The company needed to adapt, and quickly. It needed to innovate, to reconnect with consumers, to find its place in a changing world. The next few months would be crucial. Wall Street was growing impatient. Investors were demanding results. And looming on the horizon was a quarterly earnings report that had the potential to make or break Kraft Heinz's future. As news of the company's struggles began to leak, the stock price started to wobble. Analysts sharpened their pencils, preparing to dissect every line of the upcoming financial statement. The pressure was mounting, and all eyes were on Warren Buffett. Would the Oracle of Omaha's faith in Kraft Heinz be vindicated? Or was this the beginning of the end for one of his biggest bets? The clock was ticking, and the stakes couldn't be higher. In boardrooms across the country, executives watched with bated breath. If Kraft Heinz could turn things around, it would be a masterclass in corporate resilience. If it failed, it would serve as a cautionary tale about the dangers of short-term thinking in a rapidly changing market. As the day of the earnings announcement approached, tension reached a fever pitch. Rumors swirled about potential write-downs, missed targets, and management shakeups. Buffett remained stoic, but those close to him could see the strain in his eyes. The night before the big reveal, Kraft Heinz's CEO made a last-minute call to Buffett. The news wasn't good. The company was going to miss its earnings targets, and by a significant margin. Years of aggressive cost-cutting had finally caught up with them. The brands that had once been cash cows were now struggling to stay relevant. Buffett listened in silence, his mind racing. He knew that come morning, the market would react swiftly and mercilessly. Years of goodwill could evaporate in a matter of hours. His reputation as the world's greatest investor would be called into question. As he hung up the phone, Buffett stood at the window of his office, looking out over the city he called home. He thought about all the times he had preached the virtues of long-term investing, of buying great companies and holding them forever. Now, he was faced with a dilemma that would test those very principles. Should he cut his losses and admit defeat? Or should he double down once again, betting that Kraft Heinz could reinvent itself for a new era? The decision would shape not just the future of the company, but Buffett's own legacy as well. As the first rays of sunlight began to peek over the horizon, Buffett made his choice. He would face the music head-on, take responsibility for the missteps, and chart a new course forward. It wouldn't be easy, but then again, nothing worth doing ever was. The next morning, as the earnings report hit the wires, Wall Street reacted with shock. Kraft Heinz's stock plummeted, wiping billions off its market value in a matter of minutes. CNBC anchors scrambled to make sense of the carnage, their voices rising in pitch as they described the scale of the losses. And there, in the eye of the storm, stood Warren Buffett, calm, composed, but with a glint of determination in his eye. He knew that this was just the beginning of a long and difficult journey, but he also knew that adversity often bred opportunity. As the dust settled and the recriminations began, one question hung in the air, unspoken but omnipresent. Would you keep investing in a struggling company, or start cutting your losses? The answer, as Buffett well knew, would determine not just the fate of Kraft Heinz, but the future of value investing itself. The game was far from over. In fact, it was just beginning. Then came the disaster Buffett feared. In early 2019, Kraft Heinz dropped a bombshell that sent shockwaves through the financial world. The company announced a staggering $15 billion write-down on some of its most iconic brands, a stark admission that their value had plummeted. The market's reaction was swift and merciless. Kraft Heinz's stock price nosedived overnight, shedding more than 25% of its value in a single, brutal trading session. Financial news outlets wasted no time in declaring this Buffett's most catastrophic misstep. Headlines screamed across screens and newspapers, "Buffett's worst investment yet." The Oracle of Omaha, long revered for his financial acumen, suddenly found himself in unfamiliar territory, the center of a storm of criticism and doubt. In public appearances following the announcement, Warren maintained his characteristic calm demeanor, but those who knew him best could see the disappointment etched across his face. For a man accustomed to making billion-dollar decisions with unwavering confidence, this was a rare moment of visible uncertainty. The true test of Buffett's resilience came during Berkshire Hathaway's annual meeting, an event typically filled with praise and admiration for the legendary investor. This time, however, the atmosphere was markedly different. For the first time in decades, shareholders openly questioned Buffett's judgment. The usually adoring crowd now harbored doubts, with some even going so far as to accuse him of being out of touch with modern market realities. One particularly vocal investor stood up during the Q&A session, his voice tinged with frustration. "Mr. Buffett," he began, "how could you have missed the changing consumer landscape? Aren't these the trends you've always prided yourself on identifying?" The room fell silent, all eyes on Warren as he absorbed the pointed critique. Buffett, ever the statesman, took a deep breath before responding. "You're right to question this decision," he admitted, his voice steady but tinged with regret. "We clearly misjudged the speed at which consumer preferences are evolving. It's a reminder that, even after all these years, the market can still teach us painful lessons." Behind closed doors, the toll of the Kraft Heinz debacle became even more apparent. In meetings with his closest advisors and Berkshire executives, Buffett didn't mince words. He candidly admitted that he had underestimated how rapidly consumer tastes could shift, particularly in the food industry. The man who had built an empire on identifying value now found himself grappling with a rapidly changing marketplace. "We got this one wrong," Buffett told his team during a somber strategy session. "Our models didn't account for the speed of disruption in consumer packaged goods. We need to reassess how we evaluate these types of investments moving forward." The emotional low point of the saga came when Warren agreed to a rare, candid television interview. Sitting across from a respected financial journalist, Buffett's usual jovial demeanor was noticeably subdued. As the cameras rolled, he uttered words that sent ripples through the investment community. "I made a mistake," Buffett said, his voice carrying the weight of billions in lost value. "We overpaid for Kraft Heinz. It's as simple as that." The admission hung in the air, a testament to Buffett's integrity even in the face of a colossal misstep. The fallout from this public acknowledgement was immediate and far-reaching. Social media exploded with reactions, ranging from shock to grudging respect for Buffett's honesty. Longtime Berkshire investors found themselves in uncharted waters, grappling with the realization that their infallible leader was, in fact, fallible. In the days that followed, financial analysts dissected every aspect of the Kraft Heinz deal. They pored over balance sheets, scrutinized market trends, and debated whether this was a one-off error or a sign of deeper issues within Buffett's investment strategy. The question on everyone's mind: had the world finally passed Warren Buffett by? The pressure wasn't just external. Within Berkshire Hathaway, the Kraft Heinz disaster sparked intense discussions about the company's future direction. Young executives argued for a more aggressive approach to tech and digital investments, while Buffett's old guard cautioned against abandoning the principles that had built their fortune. As the dust began to settle, Warren Buffett found himself at a crossroads. The Kraft Heinz write-down had exposed vulnerabilities in his time-tested approach. Consumer brands, once considered unassailable fortresses of value, now seemed susceptible to rapid shifts in public taste and disruptive newcomers. In private moments, Buffett pored over reports and market analyses, determined to understand where he had gone wrong. He reached out to industry experts, seeking fresh perspectives on the changing landscape of consumer goods. It was a humbling experience for a man accustomed to being the smartest person in the room. The question now looming over Buffett and Berkshire Hathaway was clear. Could they find a way to recover the lost value? More importantly, could Warren Buffett adapt his investment philosophy to a world moving at breakneck speed? As news of the Kraft Heinz debacle continued to reverberate through financial circles, a new narrative began to emerge. Some saw this as an opportunity, a chance for the Oracle of Omaha to demonstrate his legendary resilience and adaptability. Others wondered if this might be the beginning of the end for Buffett's remarkable run. In boardrooms and investment firms across the globe, the Kraft Heinz story became a cautionary tale. It sparked debates about the nature of value in a digital age and the dangers of clinging too tightly to outdated models. For many, it was a stark reminder that even the giants of finance are not immune to the winds of change. As the weeks turned into months, all eyes remained on Warren Buffett. The investment world waited with bated breath to see how he would respond to this unprecedented challenge. Would he double down on his traditional approach, or would this be the catalyst for a new chapter in the Berkshire Hathaway story? The stage was set for what promised to be one of the most intriguing periods in Warren Buffett's storied career. As he prepared to face shareholders, analysts, and the media once again, one question echoed through the halls of finance. Do you think Warren Buffett's value investing philosophy failed in this case, or was it just bad timing? The answer to that question would not only shape the future of Berkshire Hathaway, but could potentially redefine the very principles of value investing in the 21st century. As Warren Buffett stepped back into the spotlight, the world watched, wondering if the Oracle of Omaha had one more miracle left in him. The fallout from Buffett's Kraft Heinz investment was swift and merciless. In February 2019, the company shocked Wall Street with a staggering $15.4 billion write-down on some of its most iconic brands. This wasn't just a minor setback. It was a full-blown admission that the value of these household names had crumbled. The market reaction was brutal. Kraft Heinz's stock price plummeted, shedding over 27% of its value in a single, chaotic trading day. Financial media outlets pounced on the story, their headlines screaming variations of Buffett's biggest blunder. And has the Oracle of Omaha lost his touch? For the first time in decades, Warren Buffett found himself on the defensive, facing a barrage of criticism from all sides. Shareholders, who had long revered Buffett as an infallible investment guru, now openly questioned his judgment.